Okay, so moving forward to our next transaction that needs to be analyzed. The next transaction would deal with, it tells us, suppose that we paid $300 on our account. Suppose that we paid $300 on our account. Okay? Step one, identify the keywords. What are the keywords? Paid is a keyword. Account is another keyword. Paid on our account. Those are your keywords. Step two, identify what accounts are affected. Keyword from paid. What is that logically bringing into your mind? Where should your mind be clicking? Keyword paid, we always know what? Cash is going down. Cash is a what? Asset. So since we paid on an account, $300, the asset is going down by $300. What account particularly? Cash. Of course, we're not balanced yet. And so we need to figure out what else is being affected. We paid on an account. Okay? So we must have paid on an account that we what? Owed. We paid on an account that we owed. That's why we paid on it. Okay? Now, I could even break it down even easier than that. Look at your keywords. Paid on an account. Paid on an account. Account. What kind of account? We have two types of accounts. Anytime you see the word account, yes, two types of accounts you need to pick from. Accounts payable, accounts receivable. Paid on an account. Which one is it? Is it accounts receivable? No. Paid account. Accounts payable. Accounts payable is an account that happens whenever you owe somebody. And now that we paid on it, what should happen to our liabilities? Whenever you pay on your liabilities, what should happen? Whenever you go to your Macy's and pay on a Macy's bill or pay on your telephone bill, what happens? Your liability does what? Go down. So obviously our liabilities are going down. And what account is causing it to go down? Accounts payable. Very good. Any effects? I know this is looking like this. We're going to fix this. I don't want to confuse you guys. Hopefully you all are following with your textbook. This is just in conjunction to what you should be doing on your textbook. Okay? I understand that this may not be the best appropriate format in terms of you being able to see everything legibly, but for this particular time, this is what we're working with. And you should be following through with your textbook. So back to what I was saying, that 2,000 earlier was expenses. I just don't want that to interfere. And we have nothing affecting stockholders' equity when we pay on our account. Nothing affecting stockholders' equity when we pay on our account. What is stockholders' equity? Paid in capital, retained earnings. What's paid in capital? Common stock, preferred stock, issuing stock. What's retained earnings? Income. None of that happened when we paid it on our account. Moving on to the next one. And the next one tells us, suppose that we collected $2,000 on our account. Suppose that we collected $2,000 on our account. Keywords, collected and account, right? Let's identify this account. You guys should start thinking what accounts are affected. There's only two accounts that could be affected when you see the word account at this level. Accounts payable, which is a liability. Accounts receivable, which is a what? Asset. So which one are we going to pick? Now we're collecting on an account. So should we pick accounts payable? No. Why? Because what can you only do on our accounts payable? Pay. That's why they call it accounts payable. Now, we're collecting on our account, which gives us the only other choice, which is an accounts what? Receivable. It's another word for collecting, receiving. So accounts receivable is affected. Now here's the catch. Some people don't realize. We collected on our account, and what did we collect? Cash. So cash is a what? Asset. Our assets are going up. How much was it? $2,000 because we collected on our account. Under which account? Cash. Now, do we have any liabilities? No. No liabilities because liabilities are things that we what? Owe. What about stockholders' equity? Anything that's affecting stockholders' equity? No. Why? Stockholders' equity are the two parts that I mentioned just a few seconds ago. So are we finished? We have $2,000 cash equals 0 right now. Is that a complete transaction? No, because it doesn't balance. So what are we missing? We collecting on an account. Cash went up, that's what we collected. But what should else happen? What should happen to that accounts receivable now that you collected on it? The accounts receivable is there to remind you that you have to collect in the future. But once you collect on that accounts receivable, what should happen to that account? Anybody? It should go down. So our accounts receivable is going down, which is going to balance out the change in assets. I'm going to say that again. Our accounts receivable is going down, which is going to balance out the change in assets. Now, as of this particular transaction alone, what was my effect on assets? What was my total effect on assets? The correct answer is 0. Your total effect on assets is 0. Why? I'll give you a quick example. Suppose I'm trying to lose weight, which I am, but let's say that I'm trying to lose weight. Let's say that I lose 10 pounds in my legs, but I gain 10 pounds in my head. What was my change in my weight? Nothing. I weigh the same. I just shifted from one part of my body to another part. Works the same with this. Our cash went up, which was an asset, but what happened simultaneously? Our accounts receivable going down. Same amount, which is also an asset. So what was my change in assets? Nothing. That's why we're finished. 0 equals 0. Make sure you understand that concept because it's very important to this transaction analysis. Last but not least, we're going to sum it up by saying suppose that we pay a dividend. Suppose that we pay a dividend of $5,000. Pay a dividend of $5,000. Again, what are the key words? The key words are what? Paid and dividends, right? So again, every time you go to that paid, you think of paid, what should be registered in your mind? Cash is going down. Cash is always going down anytime you pay something, so you automatically attack your assets. So I think it was $5,000. So our assets are going down $5,000 under which account? Cash. And of course we have to finish balancing this out. Now, remaining keyword, dividend. What is a dividend? A dividend is a distribution of income to a shareholder, period. How does that affect the accounting equation? We distribute what? Income. What are the key words of that definition? Income. Income affects what? What is income? Income affects retained earnings, right? So when you have a dividend, you distribute some of that income from retained earnings and take it out the company and give it to a shareholder. So how should that logically affect retained earnings? It should make it go down. So our retained earnings are going to go down. Well, our retained earnings will go down because of the account dividends. Dividend is its own separate account. So ultimately, stockholders' equity is going down. Understand the connection. Dividends affect income. Income is retained earnings, and retained earnings is a part of stockholders' equity. Make sure you understand that from the previous lecture, the connections of stockholders' equity. So, stockholders' equity is going down by $5,000, and it's going down through our account called dividends. All right.